So on the basis that they've obviously got a, so who's winning this trade? Obviously long puts. Market maker is obviously short puts. Now, why do we not consider the calls? Why do we not consider the calls here? Because all the calls are losing money. All the calls are out of the money and they're all basically worthless. They've been worthless ever since the price went down through the key deltas, correct? So the market maker doesn't have any exposure to those positions. They're all worth zero. They're literally all worth zero. So the exposure is very, at expiry, I mean, they've got exposure up to expiry, but as expiry gets closer, the value of those options gets less and less and less and less to almost, until it becomes literally a cent, you know, going into some key levels. And then eventually it just goes to zero. Nobody's even interested in taking a 1 cent bet on these types of things, because commission's going to be wiping out that cent option. Remember, you can't just buy an option for a cent. You've got to pay a commission to buy that 1 cent option, which makes it pointless, right? So calls are all out of the money and therefore are worthless and therefore have zero impact, and basically zero impact on their considerations here, right? So the market maker option exposure goes to zero when the options expire. So what is the market maker left with? Well, if the market maker is neutral delta, how did they achieve neutral delta considering they are very, very short puts? Neutral delta means market makers are heavy short stock, right? Market makers are heavy short stock. So obviously if the market makers are heavy short stock, hitting expiry, what happens after expiry? The market maker is still heavy short stock. And now the market maker doesn't have a neutral position, do they? The market maker now has a very negative delta of minus 1.0, right? Yeah. The market maker now has a very negative delta of minus 1.0, which is effectively an outright short stock position. So if the market maker's now got a very negative delta of minus 1.0, how do you get rid of a minus 1.0 delta? You've got to buy back your stock. And as a result, last night we started to look at the buy opportunities. Last night we started to talk about the buy opportunities. Last night we started to do the buy opportunities. So when you look at last night's cash open, the original trade straight away we wanted to buy some stock. We also had this 11,330 price in charts as well. Yeah. And then we can see that these narratives in here, very, very straightforward. And we can see these trade ideas coming into play here, coming back into play here. Halfback trade, of course, comes into play here. So there's the high, there's the low swing there. And obviously we come into a halfback trade where we start to buy some more stock. Remember, the stock hasn't actually been purchased yet because we haven't had the cash open yet. So a lot of futures now getting used to hedge out that stock exposure because any drift higher now is losing money for the dealers, right? This is the problem the dealers have. That's why the futures markets gets a lot of early buyers. Because if the expiry is lower and the dealer is now short stock and the price moves up, that's a dealer loss, right? That is could potentially be a sizable dealer loss. So we want to make sure we take advantage of that knowledge until they can actually buy back those stocks. So they buy into the futures markets, which effectively ends up giving them a neutral delta position, hopefully a neutral delta position, and therefore they can now time their positioning better. They can now work through that process of timing the position better at this point. And obviously, at the moment, that's played out beautifully. Now, does it mean that if the market starts dropping that they buy it? No, because they're short stock. Potentially, they could unwind their position anytime, but they're short stock. So it means that they could make money on it, but it's not their business model to make money on that trade. You see what's happening? Simon, the market maker is net short puts. The market maker is heavy net short puts because the vast majority of commercials, hedge funds, pension funds, they're long puts from the high-priced areas, those hedge positions. So the market maker's the short side of those hedge positions. So the business model basically is that the market maker, as a rule, is short stock, long. So they're selling stock to hedge out their short puts position, because obviously most of the hedge funds, obviously to hedge a downside exposure, need to be long puts. So we know that the market maker's net position is nearly always going to be short stock, short puts, short stock, short puts. And as that short stock, short puts comes into expiry, and we lose all those short puts, the market maker is left with a short stock position, which obviously gives us a very negative delta for the market makers at the Sunday, basically the Sunday night restart, which is why we jump into the markets on Sunday night, as we told you to do last week. We told you that we were buyers on the Monday, and that's exactly what we did. We just did exactly what we told you we would do, and there's the outcomes. As soon as Sunday night started, it was a buy trade. As soon as we retested into the keys, it was a buy trade, and it's been a very, very good buy trade. We've went from 11,330s, high price of 11,410s, 80 points, $1,600. So when we look at the overall shape of this, we can see how this has played out. It's had a very, very nice upside pop, because if you look backwards, obviously, you can see that they had a lot of opportunities to maybe do business. And obviously, as we come into expiry, you can see there was a very big buyer started to show up in here. So the market makers might have done some of their business in here. You can see that as we drop down, everybody was kind of thinking that the market, excuse me, maybe there was a lot of feelings that the market was going to be turning back around in here, which might give you an upside look at the markets, right? So you started to see this. Now let's take a look at that from a slightly different angle, slightly different aspect. Now, one of the things that we could start considering on a Friday's close is how much business did they decide to close off on a Friday afternoon? Now, how do we know what the answer to that question is? How do we know what the answer is to that question? How much business did they decide to close off on the Friday ahead of expiries? How do we know the answer? Well, nobody saw the volatility change last week. It's going to be one of those weeks, isn't it? Right, so SPY-VIX, take a look at SPY-VIX on Friday. SPY-VIX went straight up. So we could start to recognize that a lot of the downside risk for the market makers was getting eliminated into Friday's close. And you can see that from this. This is an hourly chart of SPY-VIX. You can see a significant shift into Friday's lows from the price of volatility. So if you start to see the price of volatility going up based in bearing in mind that we call this scenario 2 or 3 days before Friday, we actually tweeted it out about the big buy coming in. It's really no surprise that they started to buy off the bottom edges. They were going to protect the bottom edges because they knew they were going to be heavy net short stock on Friday's close. So how do you get rid of a net short stock on Friday's close with a massive gap potential risk? Well, you close off the stock before you've eliminated the downside risk, don't you? You check to see if you've got more downside risk on the Friday. And if you don't have more downside risk, it's safer to close off the position during Friday afternoon, right? Because then you've not got that weekend gap risk at all on a massive short stock position. You understand? I know this has got a lot of depth in it in terms of its considerations, but if you think through the logic of it, it should make perfect sense. Now, it doesn't mean the market's bullish, by the way. Is there anything I've said suggesting that the market's bullish? No. The market makers are not bullish the market. The market makers are just unwinding a short stock position. That is not the same as being bullish. Bullish means buyers of top edge buy opportunities, right? That's what bullish means, not buyers of bottom edge business to liquidate, right? So that's basically a liquidation position. In other words, this is a short covering rally. Short covering rally. Well, they started to buy back stock here because the reason why they were buying back stock, how do we know they were buying back stock? Because they reduced the price of volatility. They reduced it because if they didn't buy back stock and they were still massively short stock into the close here, what happens to these guys if the market opened up here? What happens if Russia announced a ceasefire in Ukraine, for example? What happens if there was a massive unwind of the COVID measures in China, for example, when the stock market opens up 150 points, 100 points higher on the Monday? The short stock position that the market maker would have had on Friday would have wiped out huge numbers of market makers in one trade, wouldn't it? So the only way you can get rid of that weekend risk is to start the operation on a Friday afternoon. Friday afternoon is to start that operation. But the way you see that operation getting started is because they have reduced the price of volatility. So in other words, they must be really confident that they're not going to be having any downside risk in the afternoon session, but you're able to deal with that on a minute-by-minute basis rather than a weekend, right? So literally during this phase on a Friday, the market maker is able to deal with this 4-hour period live in the markets with stocks and options and futures. A weekend, they can't do any of that. The weekend, they're left with nothing except for dark pools. They're left with nothing except for dark pools to try and get some business done. So you can start to recognize a lot of that exposure was taken off the table on the Friday. And that's why we've had this simple, straightforward short covering rally. Think through the logic. Should make a lot of sense. Think through the idea of it. Think through the process of it. And you can start to see that afternoon buying in terms of the 1, 2, 3 into the bottom edges. You can see a very, very obvious buying phase, commercial buying phase. And then at the cash open last night, life to me seemed to be incredibly straightforward. We did call it live in the room last week. You all know that. We told you about that buy. We even tweeted it, so it's time-stamped. And, we said that there were going to be a big unwind of positions here. And we were right. We made some pretty straightforward, safe money. Remember, this is not bullish. It doesn't mean there's going to be a buyer at high prices, guys. So when you found that high price, I'm not going to be buying up too tight to the top edges. I'm not bullish the markets. I'm just no longer bearish for the time being until they reestablish Monday positions. Okay, so make sure you understand that. I am not bullish the stock market. I know that it's going to be a buy side pop. That's called a short covering rally. And that's the position we're in just now. So welcome, guys. As I said, it's the week of the holidays, just about to get started into that. We'll be doing kind of a just normal schedule next week for anybody that wants to pop in. As you always know, we always do the gap between Christmas and the New Year is always an opportunity just to tidy up some loose ends in terms of trade ideas and various other things. In terms of data this morning, German IFO numbers, 88.6, pretty good numbers. 88.6, prior number of 86.4, starting to suggest that all the chatter of European-wide recession maybe a little bit getting pushed to the sidelines. Order book looked relatively good, and this has been the second rising month for the German IFO. Obviously, it's well off its highs of 100, but it's also coming off its lows of mid-80. Now 88.6, suggesting that certainly that rally starting to become just that little bit better, from the very, very depressing 2020 kind of lows. But obviously, as I said, the tip back down again from mid-2021 was pretty brutal, from 100 back down to 80s. But we're on our way back up again, so that was a bit of positive news for the Germans. Moving into the other numbers this afternoon, the UK industrial order expectations better than expected. Canadian IPPI and RMPI numbers out this afternoon in 7 minutes, and the US housing market index also out this afternoon at 3 o'clock, but not very much. Not very much. So we can obviously understand that there's not very much to get our teeth into today. We have the BOJ tomorrow in the overnight session. BOJ expected, as per has been for a long time, to have no change in their base policy rate, minus 0.1%. Moving into the afternoon session of tomorrow, we do have building permits and housing starts tomorrow in the US. Not very much out of Europe at all. German PPI numbers, the only thing of any interest, but not much of a mover. They don't really pay much attention to it. The main first inflation numbers for the week comes in the form of the Canadian CPI numbers on Wednesday, expected to show a drop, which obviously would be welcomed by the general marketplace. Conference Board consumer confidence expected to start showing first signs of a bit of a positive there. And that's pretty much a quiet week coming to an end on Friday with a very important core PCE pricing index ahead of the long holiday weekend. And that's going to be one for the markets there. So the 1:30 Friday data, really the first key numbers. Obviously, we've got the final GDP numbers out the US, but there's not really much expected from those going forward. But the real ones for us is going to be the PCE numbers on Friday. So not a lot of action up to that point. It's going to be relatively quiet, relatively straightforward for a week. Nothing really driving. And obviously, as I said, really, we're going to be focused on any type of fundamental knowledge that comes out to the marketplace going into the holiday weekend, because in extended holidays, that opens the door. Obviously, there's no data releases, so it's really all about fundamentals during these holiday periods, isn't it? Weekends, holidays. So we've got to be trying to consider the basic fundamentals. If there's going to be any news bites, if there's going to be any news stories for that kind of holiday risk period, then of course the volumes being skinny could obviously cause quite substantial volatility during that period as well. So be careful if you do happen to have an open position over a weekend or a long holiday weekend. It is not ideal. So make sure you tidy up your books. Make sure that you check your accounts. Make sure that you are flat the markets so that you don't have any of that type of holiday exposure unless you want it. So welcome in, guys. I'm going to grab a little bit of lunch. Let's